Okay, welcome back, guys. So, yesterday we got to take a look at chapter 5.1 and 5.2. Now, we talked about periodic inventory and what it means to have periodic inventory and how to properly journalize it, especially when we're dealing with purchases of inventory. So, what we're doing here today is that because this is where it ties in with the next section, which is learning about the costing methods that are involved, with periodic inventory. Okay, so when we sell a product, we need to consider how much it's going to cost us to sell the product. Hence the word cost of goods sold. So we're going to be taking a look at that kind of aspect there. So we're going to be looking at the 3 different types of costing methods for periodic inventory. Now, on here, I list out 4. I'm going to explain every single one, but for this class, I'm only going to teach you the first 3, just because you're more likely to commonly see these more happen versus specific ID. So let's start with the very first one. Very first idea here is that we're going to be taking a look at first in and first out rule or method. Now, in this case, when we look at the costing methods, it actually depends on what kind of product you are selling. And I will explain each one on which one would be preferred, all right? So first in, first out is basically where every purchase that you make them in terms of batches, right? And when we do that, we are going to calculate our cost per item. And when we calculate our cost per item, right, then every batch that we purchase, right, we have a specific order, all right? So, for example, many grocery products are going to be using the first in, first out method because when we look at making purchases of batches, you generally want to get rid of your batches first. So any perishable goods such as milk, groceries, right, fruit, vegetables, anything that perishes or has some kind of expiration date, generally rule of thumb is we'll use the FIFO method. All right, meaning if I'm going to have milk, for example, I buy my first batches of milk, right? They all have expiration dates that say they're going to expire June 15th. And then because milk is such a popular product that does get sold pretty often, I go ahead and make about a couple purchases of more milk. And I get shipments every 2 weeks. So I have one for June 15 that expires for June 15, and then I get another batch that expires June 30th, and then I have another batch that expires July 15. Now think about it this way. The way that you shelf it or put it on the shelf, right? You generally will put the ones that will expire sooner in the front, and then the ones that expire later in the back, because the idea of FIFO is that you're trying to sell your first batches first, all right? And of course, if you do any other method, right? If you decide to switch it up and say you're going to place all of the most expiring ones that expire in July, you put those ones first. Obviously, the ones that you purchased first are gonna spoil, and you're gonna take a loss for that. So the idea here for FIFO is that we're going to make batches of inventory, right? We're going to make purchases of them. We're going to keep them in a specific order, and we're going to sell them in a specific order, starting with the first batch that you purchase. Those are ones that are going to be going out first, all right? Now, another type of costing method that we're going to take a look at is also going to be called LIFO. LIFO is short for last in or first out. So this one is a great example of this one is looking at technology or electronics, okay? So usually when we produce a product or when we buy specific products, so such as laptops or I use the iPhone for example, right? Apple makes a bunch of iPhones, right? But every time they try to sell the iPhone, right? Usually the later model sells out first, right? So we have iPhone 8, 10, 11, and 12, right? Most cases when you're selling them out first, right? Most likely you're selling out your 12s first more than your 8s. Okay, so that's the idea here, is that my batches came in batches, and how I am selling them is that usually the later ones that I've purchased are going to be sold first. All right, so anything that has to do with technology is a great example of why we would use LIFO. All right, or any house wear products or things that don't have expiration dates or long shelf lives. Usually they will stack the most recent ones. They'll stack them in front first. So you can think about like if you sell mops or something, right? Usually sometimes every year or every so often a mop will have like a different look to it or a different model to it. So usually you'll put those ones in front of the older models, and those ones will come out first, or those would be sold out first, okay? Because it's newer, sleeker, and more better looking, whatever reasons it is. But that's how we're going to calculate it, is that when we purchase our inventory, we purchase them in batches, but this time we're going to consider the order once again, and this time we're going to sell out whatever we purchase last, or the most recent purchases, we're going to sell those ones out first, okay? Then we're going to talk about moving average / weighted average. So in this case, we are going to not consider purchasing items in batches. We're going to consider looking at an overall amount of total quantity and total cost. So in this case, when we look at weighted or moving average, depending on which method, tracking method we're using. So when we talk about periodic inventory, we will be looking at weighted average, okay? When we dive into perpetual inventory, that's where we have moving average, okay? So for today, for this class, I think we're going to take a look at it on Monday. We will be looking at weighted average, weighted average, because we're looking at periodic inventory. Now, when we look at understanding what an average is, it's just exactly like how math works, right? When you are looking at an overall total cost and you're looking at an overall total quantity, you want to spread the cost amongst the total amount of units that you have to get an average cost. And that's going to be one of the methods that we're going to be looking at throughout the week. Now, again, a good example would be something that you are constantly purchasing, and it could be something that's you're constantly selling out as well. So things like bottled waters, right? Because it's a natural resource, right? Everybody needs it. So the store is going to constantly be purchasing it over and over and over again, because even though it doesn't really have an expiration date, but because it's a necessity that consumers need and have to have, therefore, like, the store is going to continuously keep buying them. And at this point, right, we want to make sure that our water isn't costing at such an expensive price. We want to make sure that when we sell it to our customers, that they, it's not gonna like bottled water should be average price, should be normally about roughly $2.99 or $3.99 for a case of 24 or something like that. The customer is not going to be willing to pay $10 or even $20 for bottled water, right? It's also dealing with the consumer as well, that when we're looking at selling a product, we have to consider like, well, we want to make sure that it's a consistent price. Whereas FIFO and LIFO, right, it depends on the market, depends on the availability. Things can go over or things can go under. But in this case, when we look at weighted average, we're spreading the cost evenly amongst the total quantity that you have on hand. So therefore, it doesn't matter what or when you purchase your inventory. It doesn't matter what cost you purchase your inventory, because at the end of the day, we're going to calculate a total cost. We're going to sum up our total quantity, and we're going to distribute the cost amongst the total quantity to find our weighted average. So once again, water bottles at a grocery store is going to be probably the closest thing that you would most commonly see for a weighted average. Now, in most cases, it's also the easiest form of calculating calculating cost. And you'll see as we go through each class day, so every day that we go through a method, you will see that it will gradually get easier and easier and easier, because you're learning a concept, you're applying it over and over again, but the way that we calculate it is going to be different. So once again, and most commonly that you'll see most businesses that they will tend to become a little lazier, especially when you're dealing with millions of products that you sell. If you do the average costing, it's the easiest one and it's the quickest one to calculate. So, and on top of that, instead of having to keep in order which batches came first or which batches you need to sell first because you purchased them last or whatever, you don't have that idea anymore. You just take it as a whole group together and you distribute the cost evenly, and you'll end up calculating a lot more easier. Okay, so those are the three that we're going to be taking a look in class. The last one that I do want to explain is going to be specific ID. Now, specific ID is going to be something like an auto mechanic type of repair shop would have. So what a specific ID does is that when we're looking at these type of businesses, right? When a car comes in to get their something fixed, like their transmission, a water pump, or they need to get an oil change or things like that, or tire fixed, right? What happens here is that the owner of the auto repair shop, they are going to have to hold some kind of inventory to manage each part, because every part, when a car drives in, right, you're not going to have a universal car part that's able to be compatible for every single car. It has to be based on the car model, the brand name, the year that it is released, right, and the specific part itself, right? If you're looking at a Honda Accord 2019 water pump, then that's why it is specific, because it's going to be tagging each item with a specific identification number, right, which is associated with the specific part. So in this case, right, an auto repair shop, they'll keep a way of inventory, right? They'll have most common brands, such as like Toyota and Honda, right? You see those more often out on the street. So they'll carry those kind of parts, and they'll also carry off the market or what do you call them? Black market types of parts as well. Things that aren't official manufacturing parts or things that are, knockoff brands, we can call them, that are generally run cheaper. But that's exactly what a specific ID does, is that you're keeping inventory at specific based on specific criterias. So again, an auto repair shop will look at the car model, the car brand, the year it came out, and also the specific item that you're looking for. So this is more for like not one shoe fits all sizes. It's specific to the customization of whatever part that they're looking for. And that is specific ID. And in this class, that's a little more advanced level of accounting once again, because in this case, it's pretty straightforward, right? You're going to be tagging each item at a specific cost, and you're just going to calculate it as whatever it is that you are, service, product that you sold, etc., etc. But in this case, we will not be learning specific ID, right? However, I explained what a specific ID was. I explained the idea of how you would use specific ID. So for this class, I want you to know that specific ID is going to be one of the costing methods that exist for dealing with inventory. However, we're not going to learn it in this class. So if I ask you, what are the different methods of calculating the costing methods for inventory, and I say specific ID is one of them, and you say it's not one of them, that is wrong. Okay. So now that I explained the different types of costing methods that exist for inventory, let's go ahead and get started with the very first one. All right, first in, first out method. Okay. So again, when we're looking at the first in, first out method, right, here are a few formulas that you should know or kind of understand. All right. So once again, the purpose of doing FIFO is that if you are doing groceries, right, you can consider selling out your first batches first because of the idea that your food is going to expire. Now, with that being said, here are the different types of formulas that you need to know that's going to help you create those batches of inventory, right? First one is going to be determining a purchase price. So straightforward, right? When we look at purchasing our items, right, we're looking at how many items we're purchasing it and at what price we're going to be paying to purchase it. So purchase price is pretty straightforward, right? It's quantity times the unit price to get your overall purchase price. Then we're going to take a look at total cost. Total cost is going to be your purchase price plus your freight. Okay, so in this class, we're only taking a look at freight expense. We're not going to be looking at any other expenses, but do not think that there's only freight expense, right? You can be taxed for these items. You can be, you may have to pay foreign shipping costs because you're shipping it items from overseas. You may need to have storage fees or even shipping or even expedited fees. Anything that's going to be included is going to be considered something that you're going to be including as a total cost. So whatever, as we mentioned before, right? Anything that gets the asset to your store is going to be considered part of the total cost. But in this class, I'm going to keep it real simple. You're only going to be learning freight expense. Okay? So once again, to find the total cost, it's going to be your purchase price plus your freight expense. Okay? then that's where we're going to start calculating our cost per item. So in this case, right, our cost per item is going to be our total cost divided by our quantity, right? When we look at our total cost, we're spreading the cost evenly amongst the quantity that you purchased, okay? So you could think about it when you purchase items at the store, right? If you purchase a shirt and then you add tax to it, then the price of that shirt, it's going to be, or the total cost is going to be your purchase price plus your tax, right? And that's going to be your cost per item, all right? And then once you figure that part out, then this part right here is going to make more sense when we dive into looking at our table. We're going to be calculating our goods available, which is going to be your beginning inventory plus your net purchases. And then we're going to be looking at how to calculate the cost of goods sold, which is going to be taking your goods available, minus any ending inventory, ending inventory to get you your total cost of goods sold. All right, so these are formulas that you will be keeping in mind. So once again, if you are using Excel, you can practice this with us, as well as save these formulas into your workbook. Okay. So once again, here's going to be an example. So we will also be practicing how to journalize as well. So for first example here, for the following items, we're going to journalize the transactions, and we're going to assume that sales tax is 8.725%. In this case, I'm not going to do that number. We're going to look at it at 8.25%. But in this case, the sales does not matter, all right, because we're only involving with just purchases only. So again, we won't learn about sales until chapter 6. So that part you can ignore. So here on June 1st, you made a purchase of 100 toys at $1.25 with the freight costing you $28. So once again, we're going to journalize this, right, as purchase expense for $125, and we're going to do freight expense for $28 to give us a grand total of $160, I believe. Okay.
You're saying the freight is $28. I have it as $25.
Oh yes, I'm sorry. I'm sorry. I read that wrong. Okay, yes, so $25. So here, purchase expense was $1.25 each, right? And we purchased 100 of them. So therefore, boom, $125. Freight is $28.5, which gives us a grand total of $150. Right? So here, what we've been practicing and what we've been learning is that we would calculate it and enter it into our journal. Well, instead of doing that, we are going to be introducing you to the inventory worksheet, all right, the periodic inventory table. And what you're going to notice that there are sections in the periodic, in the inventory worksheet. So the section that we're going to be focusing on will be the very first top part, which is going to be dealing with purchases. So once again, to make it a lot more easier for you to calculate everything, right, we're going to enter in the information in the given sections. So very first thing is what the date is, okay? How many items did you buy? So quantity was 100. What was the unit price? It was $1.25. And how much was the freight? It was $25. So in this case, we're going to practice filling out each column. So my purchase price column is going to be consisting the formula of my quantity times my unit price. So in this case, my quantity is 100. I'm multiplying it by $1.25, and I get a grand total of $125. All right. Then we're going to take a look at my total cost. My total cost here is going to be my $125 plus my freight, which is an additional 25, to give me a grand total cost of 150. Now, this is where the most important part that you need to know is when we're dealing with FIFO, right? Keeping your batches organized or keeping them the way that they are, the most important differentiation between them is going to be their cost per item. So in this case, right, my first batch, I have a total cost of 150, but I also have a total quantity of 100. So in this case, right, I'm going to take my 150 and I'm going to divide it by 100 to get me my cost per item. And that should leave me with $1.50. Okay? Now, with this right here, right, what I've noticed is I'm going to be displaying colors to kind of keep track of where our inventory is going. But it's just way to kind of give us like a kind of getting used to the idea of how FIFO works. Now, once again, colors may help you. If it doesn't help you, then you're not required to need to use it. However, I'm going to teach the first section using colors, and then eventually when we get through going through more and more examples, I'll take those colors off. Okay? So once again, we're going to take a look at the second section here where we looked at this right here, which is the second section, which is the second scenario here where in this case, I have on June 1st, right, you made a purchase of 100 toys, but this time it's at $1.28, and the freight is going to cost me $26, okay? So once again, what I'm doing here is I'm just stacking up my purchases. And once I stack up my purchases, that's where I'm going to go ahead and determine which batches came first for me to sell out my inventory, right? So in this case, I purchased another 100 toys at $1.28, right? So my total purchase price is going to be my quantity times my cost, or I'm sorry, my unit price, which in this case gives me 128. Plus an additional $26 because I want to get the total cost. So 128 plus 26 is actually going to give me 154. And then once again, now we need to associate our cost per item, which in this case, we have a total cost of $154, and we're going to divide it by our batch here of 100, which gives us $1.54. Now looking here, if you want to choose to use color coding, you can. Okay, that way you can associate. Okay, this line right here is, or I'm going to make it yellow. That's going to be my first batch. My second one is going to be the second one, right? Whatever color it is. But in this case, right, I've displayed right here that I do have two batches of inventory, right? I purchased the first one at $1.50, and I purchased my second one, or it's going to cost me $1.50 for my first one, and it's going to cost me $1.54 for my second batch. So this is where I'm now using my formulas. I'm creating my batches of inventory. Okay, and here I have two batches. And now I'm going to determine which batch I purchase first, which is my 150. And when I sell my products, I'm going to start calculating it from top to bottom. Okay, so once we've done that, this is what we're going to do. Now for periodic inventory, right? Since we know the definition is that we don't technically keep track of our sales, right? We don't keep track of our inventory as often because at the end of the given period, someone's going to go down to the basement warehouse and take a physical count of all the items you have available, right? So what I'm going to do is I'm just going to tally up my total purchases because here, that's all I'm curious about. How many items did I purchase in grand total? All right? And this will make sense when we plug in our numbers into our table. So here, we have a total of 200 items that we purchased for the month. And then our total purchase price here is going to be a total of $253. Our total freight is going to be $51 with a total cost of $304. All right. These numbers are going to be very specific because they're going to help you fill out the second table below this. So having the available quantity, right? This right here is going to become your net purchases, all right? As I mentioned before in the formula, right? What is net purchases? And this is going to be your net purchases. So as we take that information, we're going to transfer them and plug it into this small table down here, which allows you to tally up your total net purchases, right? Here we bought a total of 200 items, which cost us $253, right? We will talk about purchase returns and allowances and what that does later on as we progress through the classes. But for now, I just want to make sure that you understand how to use the table. So we'll talk about purchase returns and allowances later on and how it affects your inventory. And then here, we are looking at our subtotal, which then we're going to add our freight to this. So once again, freight doesn't add any quantity, it adds cost. So here, my total net purchases is going to be 200 items at a total cost of 304 items, or $304, right? That is our total net purchases, all right? And of course, when we plug this in, right, we don't have beginning inventory, right? We're assuming that we're starting from scratch, no purchases of inventory. Or we don't have any beginning inventory. So therefore, when we plug in our numbers here, right, this is where when we calculate our goods available formula comes into play. You're going to take your beginning inventory and add it to your net purchases to get your total goods available. In this case, right, I'm assuming I don't have beginning inventory, right? And my net purchases is what I just solved from right above. I carried that down to the net purchases section, and now I'm going to calculate my goods available, which is adding my net purchases to my beginning inventory. All right, so there we have it. That is my goods available. This is what I can sell to my public, is that I have 200 units available to sell. Okay, now here is something that you should be looking forward or being aware of, is that we have one criteria. At the end of every given period, we have somebody go down to the basement or warehouse to take a physical count of all the items that are left in your inventory, right? That's going to be called ending inventory. So at the end of the month, so here we have June 15th, so we have where we split it every 2 weeks. On June 15th, you found your inventory manager told you that you had 80 toys available left on hand. So when we plug in that number right here, right, our assumption here is that we know what we have left on hand, and we also know how much we purchased in total. Therefore, our assumption is that whatever that we are missing is going to be everything that we sold. All right. So in this case, if we started out with 200 items, right, and we have 80 items available, therefore, how many items did I sell?
120?
Correct. 120, right? Now that we know that we sold 120 units, this is where FIFO is going to come into play, right? So this is what we have available, right? We have two batches available, right? One batch for 100 at 150 and our second batch of 100 at 154. Now, if we're treating this as FIFO, right, which batch are we going to use first?
The $1.50.
The $1.50, correct. So in this case, I only have 100 items in my 150. So by doing this, right, I can calculate it, or I know I'm going to get rid of the whole thing. So 100 times $1.50 gives me a total of 150, right? But I sold 120 items. So therefore, I still have 20 more items to sell. So in this case, we already sold our first 100. So now we got to consider the remaining 20 items that we need to sell. And we only have one batch left anyway. So in this case, my last one here, which is what's $1.54, I'm going to calculate it per unit basis, right? So in this case, I sold 20 items, which cost me $1.54 each. And there I calculate it and get a total of $30.80. Okay? So what I'm going to do is I'm going to combine them together because I sold a total of 120 items. So therefore, 150 plus my 80 is going to give me a total of 180.80. And that's going to be my cost of goods sold because here I calculated from my batches of inventory. All right? This is what it cost the company to sell a total of 120 items. And right, costing me at 150 and also 154. All right? Once we have this information here, that's where we can safely do this. There are two ways that you can calculate ending inventory, right? You could take the simple way where we can take our ending quantity, right? We know we have 80 items available, right? And we know by eliminating from our table here that we have 80 items at $1.54 left, right? So you could just multiply those two numbers and you should get 123.20, right? Another quick and easier way is if you have multiple batches of inventory, right? A quicker way to be able to do it is that if you know by the formula of calculating the cost of goods sold, right? You can flip that formula over, right? And in this case, ending inventory or ending balance can be determined by your total cost of goods available minus out the cost of goods sold. So in this case, we know that when we started out our inventory, right, we had 200 items costing me a grand total of $304. What we know is when we calculated our cost of goods sold, we know that we got rid of $180.80. So therefore, if I started out with $304 and I sold $180.80, I should have $123.20 remaining left in my inventory. That is usually the quicker way to do it if you're having multiple batches of inventory instead of having to calculate each one individually, right? And you can use Excel to help you produce this number a lot quicker, all right? So any questions here?
No.
Okay, so once again, notice this. When we started out with our batches, when we sold our batches of inventory, right, we're selling them as a collective, right? Because in this case, we never kept track of it. We don't individualize our transactions, right? In this case, we just find out at the end of the day how much ending inventory I have, and then in grand total, how many did I sell? And I'm just going to take it upon by batches of inventory, right? Take it out as a whole. So in this case, I got rid of 100 and I sold 120 items. So therefore, I'm going to calculate it from top to bottom. Okay? All right? Now, when we come to that conclusion where we are looking at calculating our cost of goods sold at the very end of the given period, because we are dealing with periodic inventory, right? The first thing that we do is when we purchase them, right? We purchase them as if they were expenses to the company. So when we finally go down to the basement and we realize that we actually have 80 items left on hand, this is where you need to create a conversion entry. All right? And what this conversion entry does is it's basically taking your expense and converting them into your asset or your inventory itself. So this is called an adjustment entry. It happens at the end of the given period because hence that's where you get your ending balance, right, at the end of a given period. So it's an adjustment entry. Now, when we're taking a look at how the journal is going to be looking like here, if you think of it this way, right? If we purchase all of our inventory, right, and we place them into buckets, we have one bucket for our purchase expense and we have one bucket for freight expense, right? As we go through the weeks and we sell our items, right, you're slowly transferring the items in your purchase expense and you're transferring everything from your freight expense into your cost of goods sold and your ending inventory. So here at the end of the day, right, what we're doing is we're taking those buckets of our expenses and we're going to dump them and sort them in their respective accounts. So in this case, my ending inventory is going to be my inventory. So if I know that I have X amount of toys left, I'm going to dump whatever I have my purchase expense into my inventory to make sure that I have $80 worth of 80 toys worth of inventory. And then with my cost of goods sold, I got rid of it. So at this point, I should have dumped everything that's remaining in my purchase expense and my freight expense into my cost of goods sold because I got rid of it. I sold it. They're gone. They cease to exist. So when we were talking about doing that little worksheet part right there, right? Those numbers that we calculated here is what's going to help you fill out your journal entry. Because in this case, we know everything that we need to know. First thing is we need to debit our inventory because we're converting it from an expense to inventory. So if we know at the end of the day, we have a remainder of 80 toys available, that's exactly what we're going to plug in right here. We're going to plug in that it's going to cost me $123.20, right? And same thing here, right? When we talk about cost of goods sold, we've calculated what it cost us to sell those products. So in this case, we plug that number right into our cost of goods sold, right? Then we've taken a look, because we're taking our batches of inventory, right? We're taking our bucket of purchase expense and we're dumping it out. Essentially what we're doing is we're zeroing them out. We're converting them into inventory. So in this case, I need to credit these expenses. So then at the end of the day, they reflect as zero. So in this case, right, my original purchases, right, which we've calculated here for my net purchases, the total amount of purchase expense which we solved for was for $253, right? And then we're going to also have our separate freight expense right here, right, of the $51. And if you tally up both ends, right, your debits match your credits. Okay. And this is necessary for inventory. Okay. Especially for periodic inventory. Because what's going to happen is the next section that we're going to take a look at is, well, what happens when we have beginning inventory? Right? Any questions here?
Okay, so the 304 and then the 20. Okay, I get it. The 123.20 plus the 180.80 will come out to a total of the 304.
Correct.
Okay, so now you have a credit of 253 and the $51 in freight expense. Do you subtract that from the 304?
You're not subtracting it out from the 304. In this case, it should equal up to 304. And what we're essentially doing is we're just converting. We're zeroing out those accounts. So it won't make sense until we actually dive into the general ledger.
Okay.
But as we progress, right, what we're doing is we're zeroing them out. We're taking the bucket and we're dumping them into the other two buckets of your inventory item and
Until
your
it's zeroed out.
exactly.
Okay.
Yes. Okay. So in this case, yes. Right? We originally purchased a total of 200 toys, which cost me the 253. And of course, freight expense is separate, but it's included as part of the cost of inventory, which was a total of $51. Right? Where originally when we journalized it on the debit side. So now we're taking it out by journalizing it on the credit side. Okay? All right. So now let's talk about beginning inventory. So once again, when we're dealing with doing periodic inventory, what you're going to notice is that you're not going to always start at 0 at any given time. So this is a continuation of the previous scenario, right? Because in this case, we're going to do all the way to the end of the month of June. So we're going to start on June 15 and make our way down to the June 30th, right? So what we had in the previous section is that we recognized that we did have ending inventory. Your ending inventory is going to become your beginning inventory when the new accounting period starts. So in this case, I know for a fact that on June 15, I had a total ending inventory of 80 units costing me at $123.20. Okay, I know that for a fact because I just calculated it and I converted it in there. So what that's going to do is, what you're going to notice that there is a small section on the other side on the inventory worksheet. It's going to say inventory on hand, and that's where you're going to fill that information in. Now, once again, this information only helps you towards when you actually start calculating your goods available and your total cost of your inventory when you sell it. So in this case, I have another scenario. I have June 15. I also I purchased another 100 toys, but this time I purchased them at $1.27 with a freight of $25. And then I also have another purchase on the 23rd of June that I purchased another 100 toys at $1.30. All right, and the freight's going to cost me $26, right? And I do have a key factor here that on June 30th, I should have a total of 60 toys left on hand, right? So once again, same thing we're going to do here is we're going to plug in our numbers in the appropriate boxes in the windows here. So I've already filled it out for you guys. So on June 18 and June 30th. Now, every time we start a brand new period, right, we need to start a brand new worksheet. Okay, so make sure that you are aware of that when we start our new purchases, you're starting from ground zero. There's nothing on there except for what you're going to be making purchases of inventory from that date and point on. So in this
So
case,
I'm sorry. So you're closing out every week instead of monthly?
well, no, in this case, in this scenario, I just wanted to show you an example,
Oh,
but your given accounting period can be anything. It could be every week, it could be every day, it could be every month, it could be every quarter. Okay, so I mean, at this point, like best way to make sure that your expenses and your revenues do pan out is that you should do it every month, so that you can kind of give yourself like a an overview of profitability on a month to month basis. You know, that way you could see if you're growing or not. So in this case, you could choose to close out at every month. You could choose to close out every 2 weeks, every day, whatever you as a company decide what works best for you.
okay.
So in this case, I'm closing out now. I'm closing out at the end of the month, but in this case, these are the purchases that I made since the 15th all the way to the 30th. Right? So once again, you'll begin filling out your purchase price and your total cost as well as your cost per item. So once again, here's my total purchase price for the first one. Quantity times unit cost, which gives you 127, plus 25 gives you 152, right? And we take 152 divided by 100 to give you your cost per item of $1.52, right? Same thing with the second one, right? We're going to take quantity times our unit price to give us a total of 130, and the total cost plus 26 gives you 156 to give me a total cost per item of 156, right? So once again, when we get to this point, right, and we already reached the end of our given period, our first thing we have to do is we need to tally up our totals together, right? Because these are your total net purchases, right? We purchased another total of 200 items at 257 with a total freight of 51 to give me a grand total of $308, right? And once again, these four numbers are what's going to help you fill out this section here, right? So since we've seen it before, you're going to plug all your numbers in, but now let's take a look at this because now we have beginning inventory, right? So once we solve for what our net purchases is, now we're going to consider that we have beginning inventory. We started out with 80 items costing me at $123.20, right? This is our ending inventory. That became our beginning inventory because we're starting a brand new accounting period. So here it is, 80 items. And of course, I carried down my net purchases. So now this is where your calculations for goods available is actually going to come into play. Because in this case, I now have a grand total of 280 items available to sell. And in this case, I also, it's going to cost me a grand total of $431.20. Okay.
So is that a typo of net purchase or is it net purchase? Or is because I didn't see
Oh, I'm
net.
sorry. Yeah, it should be net purchases. Yes.
It is net with an N?
Yes, with an.
Okay, all right.
Right. So, um, yes. So once you get your net purchases, right, then you'll get to this table here where you calculate your total goods available. This is all the inventory that I have available to sell. All right, so here's my little table here. I have a batch of 80 items, a batch of my purchase of 100 at 152, and then I have another purchase of my third batch right here for 100 at 156. Okay, so once again, because we know that this is my total goods available, right? You can calculate it down below here, as you can see that this is my goods available. Okay. Now, what the given scenario, we know for a fact that on June 30th that someone went down to the basement and they took a physical count and they found that 60 items are left on hand. Okay? And with that, we know how to calculate our cost of goods sold, right? It's going to be my goods available minus out my ending balance. Ending balance to get my cost of goods sold. So in this case, right, 280 minus 60 is going to give me a total of 220 that I sold. All right? And just exactly like we've followed through, right? This is what we have available. We have 80 from our previous scenario. Then we purchased 100 at 152, and then we have another one at 156. When we deal with FIFO, your beginning balance is going to be considered your very first batch because that's something that you carried over. You had this batch prior before making any other purchases. So this is the order. It goes 80, 100, 100, okay? With your 80 at 154, then your purchase of 152, and your purchase at 156. So in this case, when we're looking at calculating the cost of goods sold, we're going to be considering this factor right here. That the toys above that we carried over from the previous scenario is going to be calculated first. Okay. So once again, since I'm going to be getting rid of that whole entire 80 batch, right? We're going to calculate it right here. And we know that it's going to give me a grand total of 123.20 because we're getting rid of all 80 of items, right? You could do 80 times the 154 and you'll still get the same answer. Okay, so here I only sold 80 items. I need to get a total of 220. So therefore, I need to keep going through my batches. So the next batch I'm going to be getting rid of is going to be my full 100 items at 152. Right? So now, once I calculated this and I know that this is what it's going to cost me in total, now I only sold a total of 180 items. I need to get to 220. So therefore, I need to do another side math, right? How many more items do I need to get to 220? Well, in this case,
40.
You need 40, correct. So there we have it, 40. 40, and we're going to take the 156 because that's the only batch that we have left, and we're going to calculate it right here that 156 times 40 is going to give me a grand total of 6240. All right. Then once we get here, we're going to tally this up to get our total cost here of goods sold for the 220 items, costing me a grand total of $337.60. Right? And once again, if you still have this calculation above, you'll be able to determine, right? We have our ending balance of 60. 60 times $1.56 should get you $93.60. Or, once again, you can also take your goods available of $431.20 and subtract out your $337.60 to get you $93.60. And that's how we solve how we also calculate FIFO for our inventory. All right. So this one's the only difference in this one is we have beginning inventory. Any questions?
Yeah, okay, so I'm sorry, somebody was talking. The 93.60, is that subtracted from the 337.60? Since you still have 60 left in inventory? No.
Okay, so you're not subtracting it out from the 33760. You're subtracting, so if you look from the previous one, so We had 100 items at 156, right? So you have a total of 156. But because we subtracted out 40 of them, we're taking this 6240 and we're subtracting it out from the 156 to give us the 9360.
Okay.
Or in other words, you could take 60 times the 156 to get the 9360.
Okay.
Okay. But if you have more than one batch there, I would recommend just take your goods available of the 431.20 and just subtract the 337.60 to get your ending
The
balance.
9360.
Correct.
Okay. So at the end of the month, it does zero out. Well, at the end of your balancing, it does zero out on the cost of goods sold and the quantity that you already have on hand and have already sold.
Correct.
Okay, got it.
Yes. All right. So once again, now that another question?
Yeah, I have a question. The 60 inventory we have is from we subtracted that from the beginning inventory, right? From the 80.
No, we subtract that from the overall goods available, the 280.
Since we are using FIFO, I was thinking like 60 has to, I mean, multiply it by 1.54 to get that number. It,
Okay.
you know, yeah,
If you think of it that way, okay, so you're saying that you have 60 remaining, right?
yeah, which is coming out of the beginning balance 80.
No, it's not. Because FIFO, right? We're getting rid of that 80 batch first. So in this case, if you're looking at it that way, that's another way that you can look at it too, is that when you're dealing with FIFO, if you know for sure all of your batches that came first are going to be sold out first, that means the remaining ending balance is going to be the last thing that you bought. Okay? You're not taking it out from your beginning inventory because remember, our beginning inventory is going to be considered the first batch in your inventory. You're going to sell that out first, right?
Mm-hmm.
Apply milk. Okay? If I have milk from the previous inventory, right?
Yeah.
I'm going to sell that first. I'm not going to wait till I sell my things that I purchased and then go back to it. No, cuz then at that point my milk would be expired. So think of it that way. So when we have beginning inventory, we're actually getting rid of it first. Okay? But if you are looking at it in that kind of perspective, your ending balance is going to be the last thing that you bought.
Okay.
Mm. Okay. All right. Any other questions?
No.
Okay. All right. So, of course, that's right. We already went through this. So again, once we computed this table once again, then we have to complete our conversion entry because it is what we have to do at the end of a given period because once again, we've calculated our ending balance, we calculated our cost of goods sold, so therefore we need to take our expenses and convert them into inventory. Now, here is one difference into this conversion here. We have another contributing factor. We have another additional account that we need to consider. We have beginning inventory, right? So in this case, if you look at it this way, just exactly how Nathan was asking about when we have the beginning inventory, what do you do with it? That's exactly what this journal is telling you right here is that when we are looking at our total batches of inventory, right? We made our purchases, we have our freight expense, and we also need to include our beginning inventory. Okay? And then once we do that, right, we know for a fact we sold our beginning inventory. So therefore, we need to find a way to show that we got rid of it. And how would we do that? We would credit our beginning inventory because we got rid of it. We don't have it anymore. Okay? And then here, that's why when we look at our journal, right, we're still going to plug in the same numbers. Our inventory, first one, is your ending inventory, right? That's what you're transferring into the inventory account. In this case, it was the $93.60, right? We also calculated how much it cost us to sell 220 items. So it cost us $337.60, right? That was my cost of goods sold. But here, I only made purchases of 200 units at $257. And the freight that cost me was $51. But I had 280 available. So that's where I also need to say I also sold additional 80 units from my beginning inventory as part of my cost of goods sold. Okay, so here that's what the journal looks like. It's going to be inventory, whatever inventory item that you have. So in this case, I was specific. I bought toys. My ending is going to go first, then my cost of goods sold, purchase expense, freight expense, and then your beginning inventory is going to be your credit. Okay. Any questions here?
No.
All right, again, it will make more sense as we go through each exercise together.
Okay.
All right. So chapter review, once again, we got to take a look at how to look at making purchases of inventory, right? Purchase expense, freight expense, and however you paid it. But we also have to know that because we're dealing with periodic inventory, at the end of the given period, depending on what the scenario is, we need to create a conversion entry, which allows us to take our purchase expense and our freight expense and convert them directly into inventory and as well as the cost of goods sold. Because at the end of the period, right? Even though we made purchases of inventory, our idea is that we can't carry everything into inventory because we sold some along the way. Right? And that's pretty much it. As far as calculating it, we'll wait till the very end, which is 5.5, and I'll give you a little scenario idea there. Okay. So with that being said, it is now close to 10 o'clock, so it's about 9:50. What I'm going to do is let's go ahead and take a nice 20-minute break. And when we